Consumer spending is slowing, debt is piling up, and the FHA is covering mortgages for delinquent borrowers. Sound familiar to anyone? Meanwhile, the Fed left rates unchanged, but its economic projections raised eyebrows. Uranium prices are reacting to DeepSeek's latest move, but is the market missing the bigger picture? And if bond prices and yields have always confused you, we'll clear it up once and for all. Stick around to the end for a simple way to understand bond movements like a pro. Let's dive in. Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Rob Ferrier, and he's the CEO and founder of Flying V, our digital marketing partner. Rob, I know you were sick last week. How are you feeling now?
Much better week this week, Gary. I got hit by something nasty going around, but backing at it, ready for a great week this week. Lots has happened, as always, fast-paced environment, a lot of movement. Really excited about jumping into this episode called the slowing sales issue of the 5 things. But yeah, Gary, how was your past week?
Good. I was telling you before, I have big news. I am making plans to rent out my home for a year and travel. So found some great people to rent it. And starting May 1st, I will be out in the world. Traveling for the next year, working from a variety of places. Central and South America are going to be first on the list. El Salvador, Guatemala, Nicaragua, all on the short list. And I will never miss a chance to return to Peru.
Yeah, really excited for you, Gary. So we'll be keeping track of where in the world is Gary. You did promise me no 12 to 14 hour time zone difference, so I'll hold you that.
I am not heading back to Thailand, the Philippines, Vietnam, or Korea just yet. By the way, that was tough. In Korea, the market would open at 11:30 at night. That was a little rough.
Yeah, that is brutal, keeping tabs on that. But you did a great job, and yeah, excited for these travels, and we'll definitely stay in tune and hear all the great stories coming back to the States. This week, though, Gary, we got a great edition of the 5 things. We're talking retail sales, FHA in the mortgage space. We got the March Fed meeting, uranium, and then, as always, closing up with our DKI investor education piece, talking about bond price yield inverse relationships there. Gary, starting with thing number 1, we're talking some cooling retail sales, downward revisions, weakening credit, consumer credit. You've been saying this for a year. Productive private market economy is actually weak. The bifurcated economies we've talked about in the past. Gary, thing number 1, lower than expected retail sales and downward revisions. What do we need to know?
Yeah, Rob, as you said, at Deep Knowledge Investing, we've been talking, we're into year 2 of talking about weakness in the private market economy, about talking about a bifurcated economy where a limited number of wealthy people and people attached to the government are doing well, but most Americans are struggling. That means the aggregate overall numbers look good, but most Americans are having a bit of a rough time. We got more evidence of that this past week. The retail sales number for February came in at 0.2%. Is that good? Is that bad? Well, people were looking for a 0.7% increase. So that's a pretty big miss. Making things even worse, the January number, which was already bad at a 0.9% decrease, got revised down to a 1.2% decline, making all of this even worse. The annual number, so the change versus last month was down, was up 0.2% versus the 0.7 expected. But the annual number versus February the year before was up 3.1%. Okay, how is that possible? What that means is that we had a lot of inflation, and because we had all of that inflation, people had to spend more, the sales were up. People have now run down the balances in their checking account and their savings account. They've run low on savings. They're maxing out their credit cards. Delinquencies are up. And so they're at a point now where they can't afford these inflation ballooned numbers, and they're cutting spending. So that's what's happening. The worst case scenario is where the annual numbers are up and the monthly numbers are down. What that means is we've had inflation and a weakening consumer. That's not what you want to see.
Gary, it's been several months now. We've seen weaker sales numbers. We saw it leading up to the holidays, through the holidays. I mean, what conclusions are you kind of drawing from these continuous weak numbers?
So a couple of things, Rob. One, as we've said, the productive private economy is suffering. The only reason our sales numbers and GDP numbers don't look horrible is because we have huge amounts of government stimulus, wasteful money sloshing into the economy, and that masks these symptoms. As we were saying earlier, people have run down the balances in their savings accounts, in their checking accounts. Credit usage is at all-time highs. Credit delinquencies, so people who have run up balances on their credit cards and now are at a point where they're not paying their bills, that's up really big. One other thing we've talked about a lot is spending on necessities is up because of inflation. Again, they can keep telling us food inflation is 1 or 2%. My response is, great. You find me somebody who will tell us that in the last year, their grocery bill is only up 1%. But spending on discretionary items are taking the hit. And in fact, just as a weird example, because I'm going to be traveling for a year, I'm buying some new electronics myself. I bought a brand new laptop. The model's just out. Guess what, Rob? It's already on sale. None of this is a sign of strong discretionary sales.
Gary, we also saw Gen Z financing a burrito. It's kind of the point we made in the 5 things, meaning there's actually these afterpays, or I think it was DoorDash even released the ability to pay for your Taco Bell or your Chipotle burrito in installments. I mean, how scary is that? Or is this just a micro loan, new economy that's starting to form here? What does that mean?
Yeah. So DoorDash is allowing consumers to finance their food delivery orders. I think it's reasonable to conclude that there is increasing stress in the system if people are financing a burrito. I have 2 thoughts that I want to pass on to Deep Knowledge Investing viewers. One is if your finances are in such bad shape that you are financing your DoorDash delivery, don't do it. Then don't order out and find a cheaper way. And, let's do everything we can together to get you into a better place financially, but please do not finance your DoorDash deliveries. The other thing is, for those of you who remember 2008, it was the collateralized debt obligations, the groups of loans that were securitized and sold. That's what created the problem. My thinking on this is that if DoorDash were to collateralize bonds backed by Chipotle burritos, but specifically the ones where the customers order guacamole because that's an extra charge, that's got to be like a AAA rated credit. So we would buy the collateralized bonds backed by the Chipotle burritos if they order the guacamole.
All right. Now we're really talking finance on this show, Gary. So thank you for that.
Gary, this is what 30 years running hedge funds gets you.
Here's where we're at. Gary, moving to thing number 2. So we're talking the mortgage space. You put a note in the 5 things that apparently not much of Congress can remember, or at least anyone in DC, what was happening in 2008. Gary, thing number 2 has to do with the FHA, and you've got the FHA, meaning you, our viewers, is subsidizing delinquent borrowers and no payment mortgages. Scary stuff here, Gary.
So, Rob, I'm going to break one of my rules here. One of my big rules is never to get upset or emotional about things. I've said all along, we don't believe in deep knowledge investing. We don't believe in good markets or bad markets. Whatever the market is, that's the one that we have to trade. That's the one we have to invest in. We should be able to make money in all markets. And, having emotion tied to your trading is a bad idea. The only thing I will tell you is this particular thing actually makes me angry. And if you're listening to this and I explain it properly, you should be angry too. So the Federal Housing Authority, a government agency, so that means you, that means me, right? We are the Federal Housing Authority. It's the federal government. They are subsidizing delinquent borrowers and no payment mortgages. This is straight out of the 2008 Great Financial Crisis. FHA mortgages, 90 plus days delinquent, and that is a long time. That's people who haven't paid their mortgage in 3 months. That number is at 7.05%. Guess what? Just before the 2008 subprime bubble burst, that delinquency rate was 7.02%. It is worse now than it was then. Delinquencies jumped from 145,000 homes to 192,000 in the last quarter. That's up 32% in one quarter. So if you were the FHA, the right move there, when you have more and more people who are delinquent and not paying their bills, is to find ways to encourage people to be responsible, to pay their bills. Well, it's the government, so of course they're doing the opposite. The FHA is worsening the issue and encouraging risky behavior by not collecting payments. They offer FHA loans with down payment assistance. Basically, they're covering all down payments. They're covering closing costs. Borrowers with credit scores as low as 500, and that is a low number, can secure low interest loans with minimal financial commitment. And making things even worse, when these people don't pay their mortgages, the FHA says, no problem, we'll pay it for you. They are spending $250 million to bring 173,000 missed payments current, keeping borrowers out of foreclosure. Another way to say that, if you're watching this, is that you have spent $250 million paying for people who aren't paying their mortgages. Now, if somebody wants to say, well, wait a minute, shouldn't we care for poor people? Okay, there are lots of things we could and should do to help these people, but basically pretending that they're homeowners when they don't put money down, when they don't pay their bills, when they have no financial obligation, but somehow they own the house. People talk about the government financing it. There's no government financing. It's you, it's me, it's you, Rob, it's us. We are paying for this, and paying the bills for people who refuse or are unable to pay their own bills just skews the housing market. It is a disaster for everyone. And for those of you who are saying, well, I don't understand, who cares? Couldn't they just print more money? I will just refer you to the economic carnage that took place in 2008. And we are at delinquency levels that are worse than that. And for those of you who are a bit younger, I assure you, going through 2008 was not a whole lot of fun. And if you owned equities, stocks did not do well in that time period. They bounced pretty well after because of a lot of financial stimulus. But this is not a position that we should be in.
Yeah, that was a rough period, Gary, but it sounds like, hey, free housing sounds great. Free houses for everyone. I mean, yeah, what does the ugly side of this look like? Are we looking at what happened again in that 2008 housing crisis?
Well, so first of all, let's just talk about bad incentives. If you tell people, you don't need to put money down, you don't need to pay your mortgage, you don't need to do anything, you should just have the house. One, that does not encourage them to be responsible. Two, it turns everybody who does pay their mortgage into suckers. People feel like being fiscally responsible, like taking care of your home, you feel like a sucker. That is not good for society. And by the way, I want to clarify something. That $250 million I talked about, that's $250 a month, propping up delinquent loans instead of allowing market corrections. And so, people love to say, well, wait a minute, but these people live there and, you don't want to throw them out of their home. Okay. So for those of you who are thinking that, for those of you who think that the government should be providing a lucky group of people with free houses, because why not? I want to remind you that not only are you paying for this through more inflation, and we all know how much Americans love inflation, it's not good, right? That action prevents houses from entering the sales market, right? And so, why do we have compassion for people who are getting free houses and not paying their bills, but not have compassion for all the young people who are delaying marriage, who are delaying starting families because they can't afford to buy a house? Now, is this the only reason why young people can't afford a house? Of course not, but it's one of the reasons why. And so, we can easily have more sympathy for these young people who they're still living at home with their parents because they can't afford anything. The whole point of allowing failure is it frees up assets. It frees up assets for people to buy at a lower price. And yeah, that can sound rough, but what do you do if you're a young person and you don't have a home that's gone up in value over the last few years, right? Like, people need to have a way to get started somewhere. And the answer should be actually taking responsibility for home ownership rather than fingers crossed you win the government lottery and get free housing and pretend that you own something when the FHA is paying the bills. And by the FHA, I mean you and me and all of us together.
Yeah, interesting stuff that we'll keep everyone privy to as we get new developments, and obviously keeping tabs on those delinquency rates. This is this week's version of the 5 things, the slowing sales issue. Please subscribe to our YouTube channel. Give us thumbs up, thumbs down. If you disagree, let us know in the comments, questions that you might have. And be sure to head to deepknowledgeinvesting.com. Sign up for a free email subscription. You'll get notified of all new content being posted to the website and distributed via email. And then, as always, we'd love if you would consider a premium subscription, full access to current recommendations, buys, sells, as well as access to Gary, webinars, different guests that we have on the show, plenty of added value there, as well as no paywalls on any of the content on the DKI site.
Hey,
Gary,
Rob,
yeah.
as our marketing expert, let me ask you, should we let people finance a subscription to Deep Knowledge Investing through DoorDash?
I mean, if that's what it takes, then we might have to throw that little afterpay up there. But $100 a month. I'm not sure how much kick that can down the road. But apparently, hey, if we're doing it with burritos, we're doing it with anything nowadays. So I guess even virtual subscriptions.
What if we let people finance through DoorDash and then they get free guacamole?
There we go. I like that. Now we're really talking. Now we're solving big problems here. So, but yeah, great stuff there, Gary. Thing number 3, we're talking the March Fed meeting, FOMC, the Federal Open Market Committee. No one was too surprised until, Gary, you say the investors saw some change in the projections. So, thing number 3, Gary, March FOMC meeting went as expected, except the projections. Tell us what we need to know.
Well, so the Federal Reserve kept the Fed funds rate steady. That surprised exactly no one. And they maintained their forecast for 2 rate cuts in 2025. Also surprised nobody. That decision came with ongoing uncertainty about the economy. And, in fact, the Federal Reserve put language talking about increased uncertainty in the press release. And Jerome Powell, the chairman, during his press conference, actually talked about the difficulty of assessing inflation driven by tariffs, adding complexity. He talked about potential unexpected weakening in the labor market, and again, uncertainty. He talked about it constantly. So, one of the things that we saw, while people were not surprised by the fact that the Fed kept rates unchanged, they changed their projections, and not in a good way. The inflation projection increased from 2.5% to 2.7%. GDP growth expectation, declined from 2.1 to 1.7%. Expected unemployment rate was raised from 4.3 to 4.4. So, what we saw was government expectations were for more inflation, less growth, more unemployment. The only thing I would add on all of that is that if the lower GDP and higher unemployment is due to a reduction in government waste, that actually would be a net benefit to the economy, even though it will make the aggregate numbers look weaker.
Gary, I know you said that there was no real surprise in the decision to pause. That was expected by you and everyone at DKI. Were there any changes, surprises that you did find in any of the communications from the Fed?
There were a few. One, and I can't believe I'm about to say this, Chairman Powell pulled out the T word. During his press conference, he described tariff-related inflation as transitory. For those of you who are a little newer to the story, Powell and then Treasury Secretary Janet Yellen were describing inflation as transitory in late 2020, early 2021. Late 21, early 22. they clearly were wrong. It is still a problem now, 3+ years later. Inflation has really been a problem for 3.5 years. So 3.5 years ago, they were saying it's transitory. In the meantime, I can't believe I'm saying this, but I agree with him. If we get tariff-related inflation, and we might or we might not, but if we do, it actually will be transitory. It would be a one-time bump rather than a constant increase. So somehow I agree with him on that. Beyond that, there was a little bit of a change in the dot plot. That is just the chart where each member of the Federal Reserve, each Fed governor, puts a dot where they expect the Fed funds rate to be this year, next year, the year after, and long term. So I told you before that the expectation is for 2 rate cuts in 2025. That's still the case, but the outliers went from evenly distributed above and below that level to the outliers are now solidly above the line. And what that means is that the Fed is becoming gradually slightly more hawkish. Hawkish means favoring higher interest rates. So that was a bit of a change. And then, beyond that, the big news from the press release was language talking about increased future uncertainty for the economy. And then the final thing is the Fed reduced their quantitative tightening. So again, just a fancy way of saying in order to provide liquidity to the system and keep, people spending in the economy during COVID, what they did was they ran up a gigantic $9 trillion balance sheet. Again, just a fancy way of saying providing lots of liquidity into the market. Now, over the last couple of years, they've been reducing it. And they've taken somewhere in the neighborhood of almost $2 trillion out of that Fed balance sheet. Now, the Fed balance sheet is still enormous. It's still $7 trillion. But what they're doing is they are reducing the amount of quantitative tightening or the rate at which they're pulling stimulus out of the economy. They're being more cautious about reducing that balance sheet, meaning they're more worried right now about the state of the economy than they are about inflation.
Interesting. And glad we got some new information, or at least some new insights coming from you, Gary, out of that meeting. Gary, thing number 4, we're talking uranium. DKI, as many of you probably know, has talked about uranium quite a bit. We've seen this energy use in AI, chip processing, the whole 9 yards. We're questioning some assumptions here, Gary, regarding DeepSeek and what those projections look like and mean for uranium. Gary, thing number 4, we've seen uranium trading down over the last couple weeks, even months. Uranium price is down, but long-term outlook is strong. Tell us some good news about uranium, Gary.
Yeah, exactly. So the bad news is that the spot price over the last year or so has declined from about $106 per pound to $70 per pound. $70 is not bad pricing, but it's certainly a big decrease from where we were. And then, one of the things that really hurt pricing was DeepSeek leading people for about 15 minutes to believe that we weren't going to need all of those AI data centers. We'll get to that. So there was this concern that nobody was going to need more power. And there's also been geopolitical tension. We do get a certain amount of enriched uranium from Russia. So that caused the U.S. to rely more on Canadian exports. Okay, so let's talk about some of this stuff. First of all, Canadian exports of uranium are not able to meet demand. Canadian producer Cameco has been intentionally underproducing for years. Cameco, they've got long-term supply contracts. They are actually underproducing and then buying uranium in the spot market at a loss rather than produce more. And then we have a bunch of nuclear plants where the useful life has been extended. There is a ton of construction and planned construction going on for new nuclear plants, for new SMRs, small modular reactors. There's all kinds of growth necessary because we do need more energy. And that's the case with or without AI data centers. So, somebody might say, okay, well, wait a minute. If you have all of this demand, right, why is the price coming down? And the answer is 2 reasons. One, it takes a little while to get a nuclear plant permitted, approved, to build it. So that demand is coming, but it isn't necessarily online yet. Um, and so, that's a huge part of it. And then the other thing is there have been worldwide stockpiles. And so a few years ago, there were about 5 years of excess supply. That's down to about 2 years of excess supply. So start to do the math on this. Unless people start investing in building new mines and mining more, and right now nobody's doing that, we have shortfalls coming, right? Those stockpiles, we're living off the stockpiles. It's basically the commodity equivalent of living off your credit card. At some point, you need to make more money. At some point, we're not going to be able to draw down stockpiles that don't exist. And, we're probably 2 years or less away from that. So, there is a supply crunch coming, and we want to be there for it.
Gary, so I hear you that DeepSeek has affected the price of uranium, obviously with all the news and rollout there over the last month or so. Do you think these new models, though, are really affecting the demand of uranium, or what's your take there?
No, I don't. The DeepSeek news made people feel like, they had arrived at some sort of like that there was a free lunch, right? Okay, we've got a more efficient way to do it. But the truth is, AI depends on massive amounts of computational power. And so somebody might say, well, wait a minute, but DeepSeek was able to train their model with a whole lot less power, a whole lot less training, a whole lot less expense, fewer of the power-hungry NVIDIA chips. And the answer to that is true, but sort of. And the reason is because they didn't fully train the model. It's an inference model. And so what happens is the Western models, things like, Grok, XAI, ChatGPT, all of those models, what they do is an enormous amount of training. So the model is really ready to answer your question. What DeepSeek does is they figure out the things you're most likely to ask about, and it researches that and gets a sense of where things are. But then when you submit a query, when you ask a question, DeepSeek takes more time, more power, more energy, more computational power to answer each query. So at the NVIDIA meeting a week ago, Jensen Huang was saying that because of DeepSeek, they're expecting 100x more GPU usage. Now, I don't know if that's accurate or not. I'm certainly not in a position to pretend I know more about this than he does. But the point here is that with lower prices, there's going to be more demand. And even if the model switches from the current one, which is processor heavy at the beginning, processor light at the end, to the DeepSeek style inference models, that just means a longer period at the end of more power usage, more CPU usage or GPU usage. Basically, there's no free lunch on this stuff. It's not that one model is necessarily more efficient than the other. It's they have greater power draws at different points in the model's life cycle.
Very interesting, Gary, and thanks for breaking that down. Again, this is the version of the 5 things for this week called the slowing sales issue. Be sure to head to deepknowledgeinvesting.com, sign up for a free subscription, as well as a premium subscription if you'd like to upgrade and get access to all gated content, current recommendations, and buy and sell recommendations as well. Or please just subscribe to us on YouTube, leave a comment, question that you might have for Gary, and we'll be sure to take a look at that and maybe even show up in 1 week's version of the 5 things. Gary, to wrap up the show, we're moving into investor education. Today, we're talking about bond price and the yield inverse relationship. Gary, I'm going to turn it over right to you with this question. How do interest rates affect bond yields and pricing? Thing number 5, break it down for us, Gary, and I'll try to follow along and ask good follow-ups.
All right, stick with me here because this can be confusing for a lot of people. It's a key concept in understanding the fixed income market, just a fancy way of saying bonds. It's the inverse relationship between bond yields and prices. So when bond prices rise, yields fall. When bond prices fall, yields rise. So let's talk about the reason for it. So think about the value of a bond. Rob, if I, sell you a bond what you would have is a promise from me to pay you periodic interest, maybe every month, every quarter, every year, and a promise to repay you your principal at maturity, at the term that we've decided on. So the value of what you would own in that situation is the sum of the present value of all the interest payments plus the principal you receive at maturity. So if interest rates rise, newly issued bonds would offer higher yields, making older bonds with lower yields less attractive. As a result, the price of bonds with lower yields would drop. So we can go to a concrete example. Let's talk about a 10-year treasury note with a face value of $1,000 and a 5% coupon rate, and that's the example. So that bond would pay you $50 in interest annually, and 10 years down the road will give you your $1,000 back. So if market rates rise by 50 basis points, 0.5%, new bonds will yield 5.5%. And so instead of $50 of interest, they're paying you $55 of interest. To stay competitive, the older bond would need to drop in value to $962. So it would lose $38, assuming it still has 10 years to maturity. And the reason is because the yield on the old bond needs to match the yield on the new bond, right? The market will arbitrage or take advantage of discrepancies in pricing, right? So, we can give you another example here. Imagine you purchased a 10-year note in January of 2021 when the yield on the 10-year note was about 1%. So new 10-year notes right now have a yield of about 4.25%. So the difference is another 3.25% more in interest, right? 4.25% now, 1% in 2021. So your older bond becomes much less desirable because you're only getting $10 of interest versus, $42, $43 of interest.
Yeah.
And so the only way that the value of your old bond will be able to compete is to lower the price.
Gary, with that being said, it seems like, understanding the Fed interest rate factors. I mean, how critical is that when it comes to investing in bonds and understanding what that means if this is something that you're interested in?
So it does matter. It matters to the extent that most of the yield curve, and I'll explain what we mean by that, gets priced off of the Fed funds rate with exceptions. We'll go through that. So when we talk about the yield curve, we're talking about the rate of interest for the overnight rate. That's the Fed funds rate. And then people will look at the 1 month, the 2 month, the 6 month, 1 year, 2 years, 3 years, 5 years, 7 years, 10 years, 20, 30 years. And so what we look at is the interest rate throughout the yield curve, the interest rate on the short maturity notes and on the long maturity bonds. And so that's the thing that we're looking at there. Now, here's the exception. The exception is that the market will make its own assessment. And we got a great example of that starting last September. Last September, the Fed started to cut interest rates. And ostensibly, the reason they did it was to reduce borrowing costs for people. Well, guess what happened? The Fed cut interest rates over the next few months by 100 basis points or 1%. But the yield on the 10-year note actually went up by 100 basis points or 1%. So what we saw was that the Fed funds rate came down and the yield on the 10-year went up. Why is that? And the reason is because the market was correctly understanding that lower interest rates lead to more inflation. And so the market was discounting the value of the payments on the 10-year for higher inflation in the future. And as a result, took down the price, which raised the yield. And so what the Fed does matter, but sometimes the market will move in the opposite direction. And this is a situation we just saw it a few months ago where the Fed lowered rates and the market actually increased the market rate of return on bonds. And that's the reason the yield curve uninverted For those of you who really like the terminology, what that's referred to is a bear steepener. And what that means is that the yield curve gets more steep, meaning higher at longer durations. But the way you get there is by having lower prices and higher yields on the subsequent issues of the longer bonds. Again, that's more complicated than we intend to go into here. But for those of you who know this stuff and want the language on it, that's called a bear steepener.
Very good stuff, Gary. And thanks for breaking that down for us. If you have any questions or different topics you'd like us to cover in this education portion of the 5 things, again, please leave us a comment. Head to deepknowledgeinvesting.com, use the Ask Gary feature. Would love to continue education of our audience, new, beginner, basic, intermediate investors, as well as advanced as well, with some of these topics that we cover. That concludes this week's version of the 5 things. Gary, always a pleasure being on with you here. We'll be here next week as well, keeping you in tune with everything that's happening in the investment markets and making sure that you're up to date, know everything that needs to be known about the market to make the best decisions possible for you and your portfolio moving forward. Gary, turn it over to you for the last words.
Thanks, Rob. So another great week by DKA interns, Josh Reeves and Cash and Crow. As always, so much of the work that you're seeing here is based on research that these college interns have done. Really great work on their part. By the way, Josh did something incredible. I told him to use a calculator to figure out the curves on the changing interest rates and how it changes the value of a bond. He just wrote a Python script that gave us curves for it. Gen Z for the win on that. I was not going to be writing Python scripts. Great job on that, Josh. For everyone who's watching this, I just want to let you know, of course, we know your time is valuable. We appreciate you spending it with us. I also understand that particularly on the educational thing we were talking about at the end, some of this stuff gets really complicated, and we do the best that we can to break things down for you and make things more simple and more approachable. But if you have follow-up questions, put it in the comments, or, just go to deepknowledgeinvesting.com. There's the Ask Gary button at the top. And, if we need to revisit this topic and simplify some things or explain some of it further, we'll be happy to do that for you. As for the rest of you, we will see you in next week's video. Looking forward to figuring out what in the world's going on this week.
Thanks, everyone, for watching.